Welcome, everyone. My name is Ryan Hill. I'm going to give you a very quick intro to sensitivity analysis and capital budgeting. So, jumping right in, big picture, the goal of financial management is pretty simple. We want to grow the value of our business for the owners, but do it in a way that keeps the company healthy. I like to look at it as my household budget. Of course, I want more money coming in, but I also need to pay rent, have my groceries covered, and keep a little cushion for emergencies. For example, yesterday I had to pay $700 for my daughter's cheerleading camp this summer. So it's the same idea. It's not just about making a profit this quarter. We have to make smart decisions that we can grow, be prepared, and still sleep at night. So, how do we do this? Financial management has a few main buckets. I generated this graphic here to make it a little easier to see. First is planning and forecasting, basically looking ahead so we're not flying blind. So, for example, if we think sales are going to dip in July, or I am going to have to buy a bunch of uniforms for private school this summer, I can expect less cash flow coming in, and it won't be so scary in the summer when I'm trying to plan for a fall vacation. Next is investment decisions or capital budgeting. This is where we decide if a big purchase is worth it. Should I buy a uniform press or should I get a new closet to store it? Tools like net present value and internal rate of return are just different ways of asking after we spend the money, are we really going to get enough back to have made it worth it? And lastly, there's financing. Where's the money going to come from? Do I take a loan, bring in investors, or use profits I've kept back in the business, like savings outside of emergency savings? Um, so it's the everyday survival stuff. And again, a super simple example would be you can be profitable on paper, but if customers take 60 days to pay you and you still have to pay your suppliers next week, you can quickly run out of cash. So collecting payments, managing your inventory, timing of the bills, all of it's important because you're balancing risk and return. Because a risky expansion or that new press might pay off big, but if it puts my household or the company one bad month away from missing payroll, it's not going to be worth it. So jumping into qualitative and quantitative steps in sensitivity analysis. Sensitivity analysis is basically a finance version of, all right, well, what happens? Because if we're being honest, life has its own opinions against our plans and doesn't always pan out the way we thought. Qualitative comes first, and that's mostly common sense. So we'll name our decision, launch a new product, expanding, buying equipment, hiring a whole new team. And then we ask, what assumptions are we going to bet on? The price, how many units sell, cost, interest rates, timing, etc. So a quick example, if I open a new coffee shop or I want to open up a new kiosk for an existing coffee shop, I assume 200 customers a day. Well, what if it's 150 or 250? What could move this? Where's the needle going to go? Thinking before we start crunching the numbers, which is the quantitative part, is where we actually test it. So we'll build our baseline model and say our net present value is 50,000 if everything goes normal. If I tweak one input at a time and see how sensitive the answer is. For example, if everything stays the same but sales drop by 10%, does my net present value drop to $5,000, $10,000, or does it go negative? After I run those numbers, we can make one change at a time and have those checks. We'll summarize it so it's obvious with a visual representation, like to see where the danger zone is, like a table, a chart, or as the text said, a tornado diagram. And jumping in lastly to internal and external methods to assess project risk and capital budgeting. So when we talk about risk and capital budgeting, the main idea here is we don't want to treat a safe project and a wild card project the same way. So if we use a mix of internal and external methods to price that risk in, we'll be safer. Internally, one common approach is the risk adjusted discount rate, or I say radar. Translation would be if the project's riskier, we got to raise the bar. Like if a tested upgrade to our equipment versus might have a 10% discount rate versus using a brand new unproven product line might make it 15% because we want to be compensated for taking that risk. We also do internal stress tests. Again, going back to sensitivity analysis, it's like turning one knob at a time. If my labor goes up by 5%, what's going to happen? Then you have scenario analysis, which is more like, all right, what if I turn on seven knobs? An example would be a pessimistic or negative scenario might be lower sales, higher risk, or I'm sorry, higher costs and 3-month delay all at once, because that's how life happens. You have the Monte Carlo simulation, which is instead of just a few scenarios, you run hundreds or thousands, and the result is less of a single number and more of a probability view, which is like there's a 70% chance this project has a positive NPV and a 30% chance it doesn't. Externally, we also want to check against the market and the industry. CAPM's one way to connect that risk to required return. A quick example would be benchmarking. So if competitors typically earn 12% return on their expansion, and our model saying 25% with no extra risk, that's probably a sign that we should double check our input. Thank you, everyone. I know I went through this quickly. Please give me some feedback. Reach out if you have any questions. And again, the generated graphics and the presentation, feel free to download and utilize for yourself if you would like. Thank you.